why do we structure?
Fundamental reason why we structure is asset protection.
We often hear people going, you're going to get sued and you're going to lose your house. That doesn't actually happen in Australia.
So there are different tax mechanisms being attached to different level of a structure.
We tend to buy properties as a partnership, often husband and wife kind of arrangement.
When we speak to our clients is that we say, buy it on his name or buy it on her name. Don't buy it on a joint name.
It's a living plan and a living document. It's not a one size fits all.
It is a living vehicle. As our goals and objective changes, the structure becomes more or less sophisticated, and that's the beauty of it. What is a right to structure today may still not be a right to structure in 3 years' time. Means that it needs a continuous review.
Hello everyone, welcome to another installment of the Investing for Doctors podcast. I'm your host, Dr. B here, and today we have Mr. Munzurul Khan again with us today.
Thank you very much. Thank you, V. Thank you for having me.
Thank you for joining us again, Munzurul.
Thank you.
I think today we're going to talk about something that gets every accountant very excited.
Right.
Yes. It's going to be the topic on structuring.
Yeah, right. Okay.
So,
love it.
I mean, structuring to me is about how you put different assets or investments under different entities. And I guess the most straightforward entity we all talk about is the individual. So obviously in Australia, there's a lot of different forms of entities, such as trusts, such as companies, such as partnerships, different varieties of the above. So let's get started with the most simple question. Why do we structure?
Yeah. Okay. Good question. Yeah. So there's two fundamental reasons why we structure, right? One is your asset protection. So there are a certain level of a structure that you don't have any asset protection, and there are a certain level of structure it gives you varied level of asset protection, right? So it's a fundamental reason why we structure is asset protection. A second fundamental reason why we structure is because different structure has different tax ramification. So a company as an example has got 25 or 30% based on how the company is. Trust as an example that it distributes the profits. It's a see-through, doesn't pay any tax. So there are different tax mechanisms being attached to different level of a structure. So asset protection as well as the tax planning is what we do, fundamental. Secondary reason sometimes what we do is that sometimes we're being statutorily obligated to do it, right?
Okay.
So it could be in different level of larger organization, right? And you're coming in as a locum, and the larger organization says, well, you need to be coming in on a corporate entity. Now, whether you're subject to a specific rule, PSI, personal service income, personal service business, that's later on, yeah? But you need to be coming in. That's our requirement coming in. And very often the employer does it because of payroll tax, because of a whole bunch of reasons from their point of view, right? So that's sort of some time why people sort of do that. There is a remote reason that why people say structuring may also come in handy, and that's finance. There are some banking requirements and finance requirement that in a certain level of structure that you get a bit more incentive in terms of borrowing abilities with the bank, and certain structure perhaps you don't get as much incentive. Yeah. So in summary, I suppose is that the asset protection and the tax are the two main reasons, and there are some subsidiary reason which could be we are obligated to, or it could be because some financing requirement.
Yeah, excellent. So now that we know why we want to structure, let's go for the most simple structure, which is a natural person.
Yes.
Right. So you and I were a natural person. The entity is in our own name, I guess. We're obligated to pay our personal income tax and all these sort of things. So I guess that's the simplest one to do. Yeah.
So as an individual, we're a sole trader, right? And then let's say locum as an example, right? And locum sort of goes and sort of works in different places, right? You work on your ABN, and as part of the Australian business number, right? As the ABN is that you go around and you sort of perform everywhere. Whatever the gross level of the income is that everything goes into your account, your share of the income, and then it becomes your responsibility is to look after the tax obligation and everything else, right? Everything gets added on your income as an individual, your taxable income. You pay tax at your marginal rate. and you look after your insurance, do what you need to do from your point of view. You look after your cost, you look after all of those, but the gross income comes into yourself. Benefit to this structure B is that it's simple. Benefit to this structure is that there's no cost involved, almost arguably, to establish this. You got to do an ABN. One can do an ABN going into abr.gov.au. It takes just a few minutes. So there is no cost involved in terms of establishing it. The benefit of this is that your running cost, the compliance cost, is lower as well. Negative, though, is that you almost have no protection in between your personal affairs as well as personal business affairs as well as your personal wealth. So as an example, you might be owning your principal place of residence on your own name, right? And if you go around and do the locum on your own name as well, then one argues that your principal place of residence, there's no risk barrier in terms of your locum risk back to your principal place of residence that you worked for years to pay off that loan, right? But because of that contingent liability, so to speak, that there is a risk that it may come back to your principal place of residence. So you don't have that barrier of the asset protection. And the second negative, I suppose, is that also the tax. There is this almost no tax planning, right? You just purely pay tax at your marginal rate and there is no planning.
Yeah, excellent. From the asset protection perspective, we often hear people going, you're going to get sued and you're going to lose your house. That doesn't actually happen in Australia as much as it happens overseas, does it? Or as a medical professional?
Yeah, look, I mean, when one argues that you've got a whole bunch of indemnity insurance and public liability insurance and many other insurances that you do have, right? And of course, you do have those, right?
As long as you're insured, I guess.
Yes, as long as you're insured, right? So you've got all of those insurances, which gives you that layer of the protection as such, right? But one sort of says that, well, those insurances still covers on the basis of terms and conditions.
Yeah.
Let's say, as an example, there's this concept called tort of negligence. And all that basically means is that I've done something which sort of been considered as negligent. Now, remembering the negligent, it doesn't mean that I've done intentionally something negligent. It could be that I just simply didn't know. It just could be that something happened that, I actually consider it was beyond my control. The law may sort of say that, well, there is still, you could have done this 1, 2, 3, 4, 5, right? So there is always that element of the risk, right? Yeah. Insurance is one of those things, right? That you sort of pay the premium every month and you sort of hope that you never have to use it, right? And if you have to, that's the time you sort of look back and say that, good Lord, I'm glad that I paid it, right?
Yeah.
So you're right, that is Australia as litigious as a country, let's say US as an example, some of those countries, probably not, right? I mean, we seem to be less litigious as a country, but at the same time, is there is still an element of the risk? There is.
Yeah. I mean, and the thing is that your medical indemnity only covers you for medical work.
Yes.
It doesn't cover you for other things, like running a business and something like that. So, if you really screw up there, they can technically go after your house.
Absolutely.
So that's one aspect to it. I guess, after the personal, we also have groups of people that can be, from a structure perspective, like a joint venture or a partnership.
Yeah.
Tell us a bit about that. I don't see them being used as often in sort of amongst doctors.
No. The partnership, or the way you say joint venture, right? The partnership is sort of being arguably the least sort of used vehicle, and probably even less than the individual as a sole trader. And the reason why it is that, let's say, if you and I go into a partnership, and you and I are going into partnership in terms of some level of construction, development projects, business,
that sounds dangerous already.
Medical center, or investing, buying, however way it is, we go into a joint venture, and a partnership means that we are both liable for each other's act. They call that as joint and several liability. So what that means is that if anything that I were to do wrong on my own, with or without your knowledge, everything is your responsibility. Now, anything you were to get it wrong with or without my knowledge, I'm still liable for it, right? So that liability is quite enormous. And that piece of the liability is that it's not comfortable, right?
Yeah. And there's not much benefit from it either.
No, there is not much benefit. I mean, I suppose the only benefit is that the structuring cost is a little bit lower, perhaps the running cost, but no, not really a lot of benefit. Probably not in my view, right? Because of that sort of the joint and several liability. Similarly, from bank's point of view, right? When bank sort of looks into that investment side of it, bank also sort of doesn't look into the right way. Typical example, right? So you could have a doctor client, and let's say doctor client also has a brother or sister, and two brothers. One gentleman is a doctor. Let's assume that they're both doctors, right? And they're both doctors, they're both brothers, and they're sort of buying a property on their own name. Let's say they bought the property for $1 million with a 900,000 as a mortgage. Let's say it's an investment property. It's receiving about 4.5% return, 45 grand. It's the return it's receiving. Now, let's say the first brother sort of goes ahead and says, all right, I'm going to buy my own principal place of residence at the moment. What the bank will do in terms of liability, i.e. the serviceability side of it, the bank will say, you've got a combined loan of 900,000. For your serviceability, I'm going to take that entire 900,000 on your name. On the other side, I'm only going to give you 50% of the rent on your name as serviceability. Then I sort of say, well, that's not fair because it is a 50-50. I'm in a partnership. But the bank says, but you are joint and severely liable. So I got to take the full debt. Then I sort of go back to the bank and say, well, then take the entire income. The bank says no, because legally you're obligated only in right of only half of the income.
Yes.
So we'll take only half of the income for you, but we'll take that entire level of the liability, right? So from a finance wise, it's also being very disadvantaged.
Yeah. And I guess we talk about this partnership thing in that we tend to buy properties as a partnership, often husband and wife kind of arrangement. And that's actually a partnership structure, isn't it?
It is a partnership structure. And see, when we speak to our clients is that we say very often, if not always, is that we say buy it on his name or buy it on her name. Don't buy it on a joint name, because when you buy it on a joint name, you've got a joint or tenants in common, right? And either way is that what it does do is that from bank's perspective is that of course the liability is there, right? But also from your risk perspective is that both of your risks are being attached to it. And then if we look through from a land tax perspective as an example, in New South Wales, is that it's being husband and wife when they own it together, it's being considered that you are in a partnership. Means that you get one threshold as opposed to husband owning few properties, wife owning few properties, you get two level of land tax threshold. Threshold is about $1,035,000 or so at the moment, right?
I believe we spoke about this in a previous podcast.
And anything above that is that you pay tax.
Awesome. So this structure, try not to use it, I guess, as much as you can.
Yes, absolutely.
Yeah, excellent. So the next kind of thing that always comes up, we talk about trust.
Yes.
And I take it that a trust actually has a lot of flavors and variations to it. Broadly, when I was going through all this, learning about trusts, they comes in sort of three different flavors. One is a unit trust, one is a discretionary trust, and the other one is a bit of a mix in between. So maybe let's go with the easiest to explain one first, which is a unit trust. What is a unit trust?
So the unit trust is the one is that where the ownership of the trust is being defined. So you've got a ABC unit trust, and you've got three unit holders, Mr. A, Miss B, and Miss C, right? So you've got three separate sort of a unit holders as such, and they've got a very defined ownership, right? So A may be owning, 40%, B would be owning 30%, and C would be owning 30%, or different percentage. So it's very defined, right? So that's, if the defined is what we need, then unit trust is the structure. And what unit trust does do is that your income gets provided on that defined level, and also your expenses gets claimed on that defined level, and that includes your interest cost, right? So very common on a unit trust is that when you have two or three different families, they join together, rather than doing a partnership, you may consider doing it a unit trust. Much better.
And does that bypass some of the issues with having a partnership because it's so defined?
Yeah. So somewhat it does. Does it go all the way at the end? Arguably not, but somewhat it does. So what it does do is that all of a sudden is that most of the financial institute would consider that you're not enjoying civil liability because you've got a very defined level of your rights and obligations as such. There are some banks at times they look beyond that and they sort of say, we're still going to consider that everyone is liable for each other because even though you're in a unit trust, you're so interconnected as such. Yeah. But that's more of an exception. Generally speaking, the joint and civil liability isn't there. So that's a benefit, right? Whenever you look through the asset protection side of it, is that one probably argues that you still don't have enough of the asset protection because you still own your designated unit. And once you own your designated unit, means that you are subject to litigation, and because the ownership is in there. So it goes somewhat in terms of taking away joint and civil liability, but it doesn't go all the way in terms of taking away the external liabilities.
I see. Because the owner of that unit is viewed as owning that unit as an asset. Yeah.
And the asset is there. And asset is there means that if there is any litigation, if there is any dispute, that bit of the asset is subject to negotiation and discussion.
Okay. All right. So now we swing to the other end of things, which is a discretionary trust. Yeah. And often, people talk about a family trust, a discretionary family trust, or just a discretionary trust by itself. Is there anything really different amongst them?
No, really. You spoke about the hybrid trust and we'll come back to it, but overall really is that it's a discretionary or a non-discretionary. And people use different names. Non-discretionary could be unit trust. Non-discretionary could be fixed trust, right? And there is a slight difference between unit fixed trust, but more or less similar. And then your discretionary trust, we may say family trust. Sometimes I hear property trust. Sometimes I hear this trust, that trust, right? But effectively discretionary trust. Now, yes, not necessarily all discretionary trust is a family trust. You got to do a concept called family trust election, right? But generally speaking, is that discretionary, non-discretionary? The benefit of a discretionary trust is arguably is probably most widely used.
Absolutely. I've got two of that myself.
And the benefit of the discretionary trust is that what it does is that it gives you that whole discretion of the distribution. And the distribution goes on the basis of the beneficiaries, and the beneficiaries are entitled to. And very often what it does is that it's the husband and wife, they're both the primary beneficiary, very often, right? Or it could be only the wife, or it could be only the husband, either way, right? And then what it does, your secondary beneficiary, which is the definition, goes into their spouses, goes into the kids and the grandkids, now and future, goes into the parents and the grandparents, if applicable, goes into brother, sister, nephew, niece, uncle, aunt from both sides, as well as any other entity that you have any ownership or control. So when you've got those two discretionary trusts, right? Like if you have got a corporate entity where you've got 10% ownership, someone else owns something else, you can still distribute in there subject to some terms and condition, right? So it's a very flexible environment in terms of distribution of the profit. Now, you've got a right to distribute to your brother. It doesn't mean you've got an obligation to distribute. That comes back to the trustee. Trustee is the one who makes the decision who to distribute to. And you, on that whole structure, you stay as a concept called appointor. Appointor has got only one right, one role, so to speak, right? And the role of an appointor is to appoint and remove the trustee. Yeah. So if I visualize this, right, you've got the trustee, who's the manager, who manages everything. But you've got the appointor who can appoint or remove the trustee.
Who manages the trustee.
Who manages the whole venture, right? The managers, right? So that means you are managing the manager. And because you're managing the manager means that you are in ultimate control. Yeah. But you are not owning anything. No one owns anything. It's a see-through entity. Even from tax point of view, there is no tax, right? Because the income comes in on the trust, it gets distributed to the beneficiaries. Beneficiaries pays tax on their rate. Now, the trustee has got right to pay the tax. You never do that, right?
Yeah,
because it's always the highest marginal rate, 45%, right? Trustee pays it. So you always distribute to the beneficiaries pays. So that's the benefit of a discretionary trust, is that you've got the tax flexibility. You've got enormous amount of asset protection because you do not own anything, you control everything. What is the negative of a discretionary trust? Anything has positive, negative, right? There's a bit of setup cost, there's a bit of running cost, one understand that, right? Negative is that if we look through from a land tax point of view, as an example, in properties, there are some of the states which has got a little bit dearer land tax.
Yes.
In
they
trust.
don't offer the thresholds.
That's right. In New South Wales, as an example, you pay land tax from $1. Queensland, there is a threshold, but it only goes to $350 as opposed to $650 odd grand for individual. In Victoria, as an example, not only there is a very small threshold, about 25 grand or so.
But they tax you more.
And then it charges you a surcharge, right? So trust, generally speaking, pays a bit more land tax. It's a deductible tax, but nonetheless, it pays a bit more land tax. Second negative of a trust, arguably, is that it's got a vested life, right? Means that it's got a defined period of time that it lives, and after that it doesn't exist. And generally speaking, it's 80 years. And what that means is that whatever assets you have on the trust, after 80 years, that trust dies, and all those assets needs to be theoretically disposed and handed over to the beneficiaries. Now that has got an incredible ramification, particularly when the wealth goes from a generation, right? Because the first generation may have built a whole bunch of assets and so, right? They sort of got old and they sort of passed away, handed over to the next generation. Next generation picks it up when parents already ran it for 45 years. So they've only got about 35 years, right? And after 35 years, they have to sell it. So now we imagine that what was being bought, say 70, 80 years ago, what is the price of this now? Significantly higher price, right? And they may not want to sell that, right? This could be the family home that they don't want to sell it, right? But the trust has got a vested life that it needs to be sold. So what is the solution to it? We stay aware of it. There are a couple of mitigating matters to it, but nonetheless, it is a negative. Now, some people may look into it saying, it's not a negative. It's 80 years. I'm not going to live 80 years.
Be dead by then.
And I'll be probably dead twice by then, right? so I don't need to worry about it. I'll pass it to the next generation. But it's about being still aware of it.
Yeah. Have you personally had to come in with circumstances where you had to do that? Fold up a trust at 80 years?
Oh, mate, quite a bit. And the reason I say quite a bit is because, see, Australia is a very young nation, right? I mean, whether we say 200 odd years, a bit more, right? So it's a very young nation. So we're sort of almost seeing that baby boomers is sort of almost having that first generation up there, right? It is massive issue, particularly with the wealthy family. And there is a couple of names. If one looked through into the news, one would see that there is a whole bunch of court cases running through saying that we do not have this trust resettlement. So it's a massive issue. So have I faced this? Unfortunately, quite a bit. There are some very sophisticated strategies that we run through with ATO, whether it's being allowable, but at this stage is very restricted. What's the logic though, right? The logic is that if we look through on the trust side of it, there is a rule on the trust, and believe it or not, what it says is that you are not allowed to rule from your grave. That's what the trust law says. So they said you're not allowed to rule from your grave. Means that, well, you can set up a trust, go through the trust, distribute what you need to do, run that through with your lifespan, right? But you can't be too much in terms of creating a whole lot of estate planning, this sort of a planning in terms of when you are passed, that you are still managing and maintaining it. It's meant to be for your generation. It's just that we use that for a multi-generation for a whole bunch of tax reasons.
Yeah, and it almost feels like that's sort of baked into the sort of the common law, and at some stage, the question is, can you actually change that or not? And
there is a whole bunch of things that people try, right? There is a concept called mirror trust. There is a concept called whether we can extend it much higher. All of those things are very dangerous, and nothing must be done without absolutely running through with very, I suppose, sophisticated and specialized lawyers who are on the trust. And number two is to run that through with the ATO, see that whether it agrees with the ATO. Outside this, very risky, because ATO can come in at any point of time saying that you've done this, you've changed the trust fundamentally.
Yeah.
If we change the trust fundamentally, it becomes a trust resettlement. And trust resettlement means is that you
capital gain
tax, you pay it as such, right? So there's a couple of minds that one need to be aware of, but generally speaking, trust is probably the best that we have.
Yeah, and a lot of people have them, and I think that's the point. We briefly touched on the trustee. I think the trustee also comes in different forms, because like you can be an individual trustee or a corporate trustee. And which one do you see sort of more of?
Corporate trustee, right? Yeah. Because if you do the individual trustee, I suppose you save a little bit of setup cost.
But survivorship.
But what it does do is that it takes away your entire asset protection. Because the trust, while being a see-through entity, it's a beneficial entity. And a beneficial entity means that the trust, sort of if there is a litigation, the trust doesn't get litigated, it's the trustee gets litigated. And while the trustee gets litigated, if it's an individual trust, individual gets litigated. But if it's a corporate entity with, say, a couple of dollars share, right, say, and doesn't really have anything else, then the risk, one argues, stays quarantined in there. What we got to be careful is that the trust also has got this estate planning component. And the estate planning component means is that even though the trustee is sort of just only there for risk protection, there's no EB and TFN, it's not lodging any return, but one still need to take into account of who are the shareholder of that trustee company.
Yes.
And that needs to be passed through as part of the will. Because if it's not being passed through, let's say as an example that my trust, I've got a few trusts, and in my trust as an example that I was the sole shareholder of my trustee company at a point of time. Then I was like, hang on. Say, if anything happens to me that I'm not there is no shareholder of that trustee company, how does the trust perform? So it becomes almost a deadlock. Then you got to go through the court, you got to go through the probate, you got to appoint someone through the probate, and only then the trust becomes reenacted, right? A simple solution to it would be is that ideally the shareholder of that trustee company becomes husband and wife both, and you also include them as part of the will. That his share goes to her share goes to him, or his share goes into a testamentary trust, her share goes into a testamentary trust. Unless and until we do that, there is a risk that it would create a whole lot of cost over time. Perhaps we can discuss estate planning on a different matter.
Yeah, but that's just a thing to note. I've seen a few people who have the individual names in the trustee, and I was just like, well,
risky.
Could have done a bit better. Yeah.
100%. And it can be changed, right?
Yeah.
Like even if you're an individual name, all one needs to do is to do a deed of variation, remove the individual,
and appoint.
Bring in the corporate entity. There's no tax ramification to it. It's not a trust resettlement. There's no CGT. It's sort of a bit of an easy fix.
Yeah.
But it should be corporate.
Yeah, absolutely. And now that we touched on corporate, I guess the last entity is a company.
Yeah.
A corporate entity. Yeah. Proprietary limited is usually the ones we go by because, it's not have enough shareholders, and, we obviously don't want it to be a public company with unlimited liability. So tell us a bit more about that.
Yeah, so the company, the benefit, I suppose, is that the tax rate is modest, one argues, right? So it's a flat rate of 25%. So whether there's a $1 profit, whether there's a $10 million profit, it's 25%, right? So that's a good thing.
That's only if you're small.
That's right.
SME,
if you become very large,
then you still
30%,
get stuck with 30%.
30%, right? So that's sort of the company's rate. So it's got a flat rate and lower than the highest marginal rate. So that's one benefit. Second benefit, one argues, on the company is that as it is proprietary limited, so your liability gets limited on the basis of what that corporate entity does. Now, there's some restriction to it in the sense that there's some caveat to it in the sense that if you do a certain things, then that proprietary limited and the limited liability doesn't exist.
You can pierce that corporate veil, they call it.
That's right. Yeah. That's right. So you can still do it. But you've got that initial level of liability and the limitation of that liability that you do have it. So corporate entity has got those two benefits. One is the tax. Number two is the limited liability. Negative, I suppose, somewhat, is that company doesn't get any CGT discount in terms of any sale of any investments, shares and properties and so, right? So it pays flat rate, no CGT discount, and does become a bit over a period of time, right? So if someone were to buy $1 million property, selling that as $2 million, that $1 million asset that you earned or gain that you had is that even if you had the highest marginal rate with a 50% discount, your maximum tax would be 23.5, whereas in the corporate entity it would be, let's say, 30% because it's an investment company.
Yeah.
Investment companies are 30%, right?
Yeah.
So let's say it'd be 30%. The gap between the 30 and 23.5, which is 6.5%, 6.5% on that $1 million is still a bit, right? And then when that $1 million becomes $2 or $3 or $4 million gain on a bunch of assets, it could add up quite a bit. So that's a negative, right? With the corporate entity side of it. Benefit of a corporate entity, though, is that it's an entity of perpetuity. As we have spoken, the trust dies after 70 or 80 years. Companies never die, right? Never die because it sort of can be run as a perpetuity. So that's that benefit. And, very often B is that while we went through the individual, the partnership, joint ventures to some extent, we're going to speak about SPV, and then we went into trust, discretionary, non-discretionary, and the corporate entity. Very often we say there is no one right structure. What is the right structure depends on what your goals and objectives are. What do you wish to do, right?
And what kind of investments you're trying to do as well.
Yeah, what's your risk profile, right? What's your time frame? What's your exit plan, right? And what are you planning to do within there? That entity, right? So it depends on a lot of things. And very often B is that we find the right level of a structure is a mix and match with all of those, right? As an example, you may have a corporate entity because you get that perpetuity and you get that sort of, 30% tax, 25% tax. But rather than having the shareholder as an individual, if the shareholder is an individual, all profit goes to the individual. You may have a trust as a shareholder. So profit goes to the trust. And then you sort of say, well, that's good, but who gets that ultimate distribution? You may have another profit holding company as an example, which gets the distribution, right? So very often you do a bit of a mix and match.
Oh, absolutely. And I think the other thing about the company is that you can retain profits.
Yes.
That we mustn't forget.
Both positive and negative, right? Yeah. I mean, positive in the sense that you can retain the profit at the company's rate. That's a good thing. The negative, though, potentially is that if you want to take it out, then you got to pay the balance of the tax to go back to your marginal tax rate, right? But the benefit, though, is that you at least got that flexibility that there's no restriction. You need to take it out every year.
Yeah.
You can leave it as long as you wish to. You can do a bit of a planning how you take it out. And there are some sophisticated planning involved where you can take it out without having to pay much more additional tax. Yeah. One got to be careful, though, of a concept called Division 7A. What's a bit of a no-no is that if I have a $1 million profit on the company, there should be $1 million cash in the company. Okay. Now, if I have $1 million profit left, I'm not distributing that profit, but I was like, oh, it's my own company. I'll just take the cash out.
Yeah.
That's what the commissioner sort of says that, well, you borrowed that money from the company. We call that a Division 7A loan, and you need to repay that with 7 years, both principal and interest.
Yeah, so that's one of those tricky situations where it can be beneficial, but also hinder things. One of the things I saw is that because you can actually retain the income, you can reinvest it at the company tax rate.
Yes.
And so, having that flexibility of timing versus the distribution in the trust structure where everything has to pass through every year can be a benefit in accruing sort of.
And a common structure what B sometimes people do is that this could be a trading entity, and you may say that yes, I like that company retention of the cash and investment in there. I agree with this, right? But the negative potentially is that this is my trading entity. I've got the risk attached to it. So you may say, all right, I'm going to distribute the profit back to the trust. Bring that profit back into another fresh company, which is purely my investment company.
Yes.
So all of a sudden you've got, this is my trading company, this is my investment company. This paid all the tax, paid the fully franked dividend into the trust, came back into the other company, means that arguably there's nominally any tax involved. Minimum. And this is where now you're holding all the cash. Because he paid that as a dividend, this company has got no right to it anymore. Means that even if there is a risk, this is being sitting as a safe zone, right? And in here, you go ahead and do a whole bunch of investments as such, right? So one can do that bit of this structure as a bit of a triangle where we have trading, risk, paying the tax, wealth asset asset in our hand that we do, and people buy properties in trust and companies, right? They buy it with the full knowledge that there is a little bit more tax on the capital gain tax side of it when they sell it, but the benefit is that the money is staying in that corporate entity as opposed to having to pay to the individual, where they pay at this rate is about 28% extra tax. So that 28% extra tax, it builds up a bit.
Yeah, I mean, and personally, I'm a numbers person, so there will become a point where, depending on how much earning you're getting and how much capital gains you'll be expecting, it may be better off in one structure versus the other. And
100%.
And if you want to hold it forever,
100%.
right? You want to hold it forever, you never sell down, then the capital gains problem is not a problem.
And you almost use that, good point, I agree, because you only pay capital gain tax when you sell it, right? Not on unrealized gains. And the beauty of those sort of the investment companies is that they also become part of the estate planning.
Yes.
So husband, wife, 2 kids, and he may sort of say, you know what, I'd love to have 2 investment companies, and I'll hand this over to him and I'll hand this over to her, our kids, over a period of time, because remembering it is a perpetuity of an entity. So it runs forever.
Yeah, absolutely. I mean, look, there's so many interesting strategies and ways to structure things, and you know, we could talk for another half an hour on what's the best way to do what in what circumstances, but I guess that's for the individual to explore their
but the point to take away in here, though, I 100% agree, right, that there is point to take is that, number one, there is no one structure. The right structure is what is right to you on a full informed basis, on the basis of your goals and objectives and your exit plan. And number 3, what is the right structure today may still not be a right structure in 3 years' time. Means that it needs a continuous review.
Yeah, absolutely. And I think one of these things that we see people is like, oh, I've already done so much in this. Is it too late to utilize a different structure now? I don't think it's ever too late. It's a living plan that you build as you go along. And I like to describe it as this concept of bolt-on. You do one thing, you might be having the family trust as the first thing, then you start becoming, running a company for your practice, and then you bolt on the practice, then you bolt on an investment company, and it just gets more and more pieces as you go along. And I say that from my personal experience that, we started off with a family trust, and then we ended up having some companies, we having some practice, we started having holding stuff, and then a different trust. So it's a living plan and a living document. So it's not a one size fits all forever kind of situation. I think that's important. And the other thing is that it's also good to have a proactive approach to this.
Yes.
Not think about what is the most cost effective today, because what's cost effective today may not be cost effective in 5 years, may not be cost effective in 20 years. And if you didn't plan with that sort of long time frame in mind, you could be paying a lot more in the long run.
And the reason why it is 100%, you're right, that you sort of bolt on, you sort of add away along the way, right? But you constantly make all of those structures accountable, in the sense that you constantly ask, do I need this? Do I need this? Do I need this on an ongoing basis? I may have established 5 years ago, probably don't need this at this stage. Do I take that off? Can I reformulate, reorganize, reutilize an original entity into a new entity? All of those that you sort of look through, right? So it's a when you're saying it's a living I suppose vehicle, it is a living vehicle, right? And as our goals and objective changes, is that the structure becomes more or less sophisticated, and it can go vertical or it can go a lot more horizontal, right? And that's the beauty of it, right? So again, the summary in my mind to all of those is that speak to your accountant. Absolutely. And raise to your accountant that what do you wish to do? And then ask the accountant to give the right level of the structure, and then ask the accountant, why are you giving this structure? What are the pros and cons? And see whether that falls in with your objective, and if it meets, that's the right structure for you.
Absolutely. And, some of my examples, I've basically set them from my own experience and my own pitfalls. So I think it's very important to have that long view of life, not just the next 5 years, but the next 20, 40 years, the next generation.
There's a huge cost in terms of changing from one to different structure, right? I mean, people sort of say, Munzurul, I've got all those different properties on an individual name. I really want to put them into a trust. Can I transfer it from my individual to their trust? The answer is, of course you can. But if you transfer from individual to a trust, you got to pay stamp duty from the trust because the trust is buying it. And you got to pay capital gain tax on your hand. So it's the same asset which is going from right hand to left hand is that you're paying all the stamp duties and capital gain tax. That's why the structure always ideally needs to be done right in day one, but the accountant should still have a sense of pragmatism, a sense of balance. We don't want to overdo with the structure because there is a time and cost involved, but we also don't want to underdo it because then there is a significant cost in future as well.
Yeah. It's a fine balance.
It's a fine balance.
And that's why I think this is a topic that a lot of accountants love talking about.
Absolutely.
Right. Thank you for your time today, Munzur.
No, thank you very much. I enjoyed it. Thank you. Thank you, Bi.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial, investment, or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.